Hello viewers, India recently became the most populous country, displacing China. Of the many factors that influence whether this population will become a demographic dividend or disaster, infrastructure in the country will be a key determinant. While a lot needs to be done in this regard, we seem to be going in the right direction. A few months ago, I had shared a video on why infrastructure is my favorite theme for the decade. You could watch the video using the link in the description section. Today, I'm going to share a very specific sector under infra, that is railways, that seems set for a massive growth, thus opening up the opportunities for the companies in this sector. I'll be coming to these companies in a while. First, let us take a look at the big policy push in the favor of the railways. Now, railway is a cornerstone of two key plans laid out under Gati Shakti and National Logistics Policy. The Indian government is investing heavily in the sector. To be specific, in the latest budget, the roads and railways allocation together accounted for almost 50% of the Capex outlay, the total Capex outlay being rupees 10 trillion. So railway Capex has gone up 9 times in the last decade to rupees 2.4 trillion and was almost doubled in the recent budget. The National Rail Plan aims to increase the share of freight traffic by rail from 27% to 45%. While many rail stocks have gained on account of growing allocation towards railways, I believe it is better to avoid companies with asset-heavy business models and with long gestation periods. While these companies may win the bidding round as L1 bidders and undertake projects, extended project cycles make the execution and the stock valuation sensitive to the shifts in the macro environments and commodity prices, along with the competition, and the return profile may turn out not to be good. I would rather focus on companies where the balance sheets and return ratio profiles offer comfort. I'm particularly interested in companies that do not have to incur a disproportionate share of capex to participate in this theme. So, moving on to these stocks, the first is RITES. RITES is a PSU engineering firm that earns a major share of its revenue from the business of consultancy services for transport and infrastructure sector for railways, but not limited to it. The other sectors that it caters to include highways, airports, seaports, city planning, and waterways, etc. Together, the allocation for road and rail both is at 50%, giving RITES both a better runway than just railway-focused companies, along with diversification opportunities. RITES seems to be the most well-placed company with respect to balance sheet, return ratios, dividend yields, and even valuations in the perspective of fundamentals. The company has a low capex business model with capex trend in the range of 100 to 140 crore rupees. The scope for its projects is diverse, such as railway electrification, dedicated freight corridors, station redevelopment, consultancy for metro projects, DFCs, high-speed railways, airports, ports, roadways, renewable technologies, Swachh Bharat, city mobility, and waterways, both in India and abroad. The company has clients like SAIL, NTPC, Indian Railways, Metro Rail Corporations, and so on. It has a joint venture with Railway Ministry, which is called REMC, in which it has a 51% stake. REMC is focused on the use of green energy for traction power of Indian Railways. In my view, REMC is likely to benefit from increased electrification in Indian Railways, along with a focus on renewable energy. REMC enjoys a margin of over 50% and is on a healthy growth trajectory. RITES order book at the end of December 2022 stands at Rs 55 billion compared to a revenue of Rs 26 billion in FY22, offering decent revenue visibility of over 2 times. Within the business, there are two key segments, consultancy that is high margin and turnkey which is low margin. While the current order book has higher share of low margin turnkey projects, consultancy is expected to contribute to over 50% of the revenues. The reason for the difference in the mix in the revenue and order book is longer period for the execution of turnkey projects. The cash and liquid investments on the balance sheet is Rs 32 billion, one-third of the market cap. The stock is trading at a PE of 17 times. Now, RITES is a limited trading history as the company was listed in 2018. Over this almost 4-year period, the median PE has been 13 times. The company has operated on a low capex model with capex trend in the range of Rs 1 billion to Rs 1.5 billion. It offers an attractive dividend yield of over 4.4%. The debt on the balance sheet is zero and the cash conversion cycle is negative, which is a good thing. With the parentage of Indian Railways and strong track record at execution, the company is well placed to make the most of the capex revival in this segment in my view, and the stock deserves to be on your watch list. Moving on to the second candidate for your watch list, Railtel. Railtel is associated with telecom infra and the execution of connectivity related projects for Indian Railways. It owns a pan-India optic fiber network providing broadband and multimedia services along with the modernization and maintenance of the communication network of the Indian Railways. Being a PSU, it enjoys the parentage of Government and Ministry of Railways both. Railtel is a beneficiary of growth in the railway Capex and network. There is opportunity for growth from content on demand, railway display network, signaling systems, video surveillance, and defense system to avoid train accidents. It is going to be a facilitator for rolling out 5G along the railway track. It is also focusing on sectors like coal, banking, defense, exploring education, health, and urban development projects as well. For example, some of its projects include automation projects for National Test Agency by offering Aadhaar-based biometric services, setting up data centers, and so on. Last year, in some projects, the company faced execution issues due to chip shortage, but the issue is easing. As against a trailing 12-month revenue of Rs 17 billion, the order book is at Rs 50 billion, offering around 3 years of revenue visibility. Order book is divided between project business, which is expected to have 7 to 8% margins, and telecom business that has 20% to 25% margins. The key aspects to monitor would be the revenue and order book mix between the projects and the telecom businesses. In FY22, the project business formed 33% of the revenue. Key risks for the company are competition from other telcos and potential chances of delay in receivables or subsidies due to significant government delay. The company is debt-free with a dividend yield of 2%. Cash is 13% of market cap. The stock is trading at a PE of 22 times versus a median PE of 21 times since the listing. Now, as railways infra projects get executed, I expect a multiplier effect in play where other sectors too will benefit. Logistics is one such sector, which brings me to the third candidate, Container Corporation. The company provides inland transportation of containers by land and associated services like warehousing, container freight station operations, and so on. The National Rail Plan aims to increase the share of freight traffic by rail from 27% to 45%. Since most of the company's terminals are rail-linked, Container Corporation is likely to be a big beneficiary of this shift. The company's market share in rail freight segment stands at around 64%. Its key triggers for growth would be double stacking and opening up of DFCs or dedicated freight corridors that will encourage growth of containerized traffic in India, which is currently below the global level. Such investments would reduce the traffic time and will allow better predictability of transit times that will encourage the shift of freight movement from road to rail. The revenue growth guidance for the company is 10 to 12%. The Government of India has 54.8% stake in the company and it wants to offload 30.8% stake. In the near term, the privatization of the company would be a key catalyst to watch out for. Now, the unfolding in the railway infra can have some multiplier effects on logistics, land, and commodity prices like that of steel. So, stay alert for other potential opportunities in associated sectors. Now, please note that today's discussion does not imply any view on the stocks. With this disclaimer, I have come to the end of the video. Do share your feedback and press the like button if you found it useful. For more such video alerts in the future, subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.